Hello folks, Steve Lentz here with Discover Options here at Option View Systems. Welcome to this presentation of 3 different market timing reports for the S&P 500 for advanced options traders. This will be for June 15th on a Friday, getting ready for Monday. Let's see if it's on the 18th. Monday the 18th. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started, if you could please hit the subscribe button. That way you'll get alerted when we come out with new videos. Also, we have a free ebook for you, Simple Steps to Options Trading Success. Just send us your information. We'll get that book right out to you. Okay? Here is the market condition that we will look at all of the reports in the context of. We define market condition in the form of 3 different dimensions: price action, trend, and stochastics. Price action, recently here we had an inside bar on Thursday. Friday's action was that of a downswing bar. As you can see, lower high and lower low. Very interesting. And in terms of trend, we are above the 50-day simple moving average. And in terms of the stochastics, we are between 60 and 100, kind of on the higher side, but we're trending downward. So all 3 dimensions make for a market condition that has occurred roughly 60 times, 60 times since January of 2000. Okay, so that is the current market condition, and we're going to reference this for the next 3 market reports that we do, beginning with the Condor and Butterfly timing report. The question here is now a good time to put on a Condor or Butterfly and begin a campaign along those lines? Well, let's take a look. Since January of 2000, we've had roughly 4,644 daily closes of the S&P 500. Of those 4,644, 64.9% have been favorable bars for selling premium, where the actual subsequent 21 bar movement was less than what was being implied by the SIBO's skew-adjusted VIX. Okay, so that is the benchmark. That's the baseline we have. 64.9% of the bars in the S&P have been favorable for doing butterflies or condors. Now, also during that time, as I mentioned, we've had our market condition that we have now occur 60 times. Of those 60 times, of those occurrences, 68.3 of the bars were favorable. That's higher than the benchmark of 64.9. So we have theoretically an edge here of 3.4%. Statistically, it's technically more likely than usual, looking at the past, okay, that our current market condition will end up being a favorable one for market neutral option premium selling. Does it mean you'll automatically make money? Well, no. You could still have the other 30%, 31.7% kick up, and be rough waters. Okay, but at least you know that at least the market condition we have now is better than normal for this. Okay, next up is the bull put spread timing report. This is for those that like to sell put premium a standard deviation away 30 days out. That's the theory predicated on this. And so, as I mentioned, we've had 4,644 closes of the S&Ps. Of those, 82.9% have been favorable bars for selling put premium like that 30 days out, a standard deviation away, where the actual 21 bar downside movement was less than what was being implied by the SIBO skew adjusted VIX to the downside. Okay, we like to skew adjust it because the out-of-the-money puts have higher implied volatility than the out-of-the-money calls. Okay, so the SIBO's skew-adjusted VIX is implying a certain downside move, and 82.9% of the time the market does not move down and touch that level. Okay, so that's the benchmark, 82.9. Now, of the 60 times our market condition has occurred, 83.3% of the bars were similarly favorable like that. It's pretty much a wash. Technically, there's an edge of 0.4%, nothing huge. We're just saying statistically it's technically one that's more favorable than the benchmark. Finally, we go to the market likelihood report. This is where we look at the market's 5, 10, and 15-day change relative to what the current market does. So let's just go to the top here. Okay, it says since January of 2000, as I said, we've had 4,600 and, oh, they counted 47 bars there, 4647. Okay, now if you were to go from any close to the close 5 bars in the future, okay, since Jan of 2000, we've had the market go up, of course. On average, you would have a 5-day rate of change of 0.1%. 0.1%. There's a 2-week rate of change, 10 days, of 0.2%, and a 3-week rate of change of 0.29%. So that's the benchmark rate of change. Now, let's go to our current market condition of 60 occurrences here. Of those 60 occurrences, the average 5-day rate of change is 0.3% to the upside. Okay, not quite 1/3%. The 2-week is 0.43. The 3-week is 0.49, almost 0.5% to the upside for a 3-week rate of change. Now, are these significant numbers? I mean, 0.3 is 3 times as much as 0.1 to the upside, right? Well, how significant is that? Well, we have to look at that in the context of the standard deviation of those occurrences. Okay, so 0.3 is, well, it rounded there, pretty much 0.2 or 1/5% difference. That difference reflects, and we come over here to the z-scores, about 1/4 of a standard deviation to the upside. So there's definitely an upward bias here. You have a z-score of 0.24, 0.21, and 0.14. Okay, these are all less than 1/4 of a standard deviation to the upside. Nothing too much to get excited about, except that they're all 3 to the upside, and there's definitely an upward bias here. Now, what I like to do is to take those 60, carve it up into those where the market, on Monday in this case, ascended above Friday's high. That happened 24 times. And then of those occurrences where the market descended below Friday's low, what was the rate of change in those cases? In those cases, you had to find, in terms of going past Friday's high, you had an upside difference of 0.83, which is a full standard deviation to the upside. So in the short term, if the market goes up above Friday's high, you have certainly historically a pretty significant bias to the upside of a full standard deviation there. Okay, so, and then on the other side, and then the other z-scores are much lower. On the downside, if it goes below Friday's low, you have a z-score of over a half a standard deviation to the downside. Okay, so just watch for Monday's action. If it goes above the Friday's high, that's a big deal in the very short term. If it goes below Friday's low, that's a big deal, but not as much as to the upside. Now, in terms of volatility, the benchmark historical volatility, what we call realized for the S&Ps, roughly 15.5 to 16% on an annualized basis, realized volatility. Okay, our current market condition yields a realized volatility between 12 and 13%, as you can see here. A bit lower than the benchmark. So let's go and look at what the VIX is currently. The long-term VIX, 30-day VIX, 11.98. The short-term one at 9-day VIX is at 10.84. Okay, so the VIX currently is a little bit less. Well, the 30-day VIX is pretty much at a 12. Our current market condition is between a 12 and a 13. So it's kind of right in the ballpark there. Okay, kind of right, just a slight tinge below. Now, if you break it out to the upside or downside, you can see that the realized volatilities actually is much greater to the upside than it is to the downside, which is interesting, isn't it? All right, interesting stuff. So, with that said, I want to thank you for joining me, and good luck trading this week. We'll talk to you next time. Bye-bye.